Good morning to day two. So my name is Darren Camas. I'm the CEO of IPOR Labs. I'm here to talk to you about from the LIBOR to the IPOR, the traditional finance to DeFi credit market evolution. So before I get started, a little bit about my background. So I've been building actually in the crypto space since 2011, across exchanges, across payments, and now I'm very excited to be building IPOR. So we're about 16 strong globally. I've been working on this for about a year and a half, and one thing is we'll be launching mainnet in August. So that's quite exciting. Okay, so the first time I gave this presentation, it was in Frankfurt. So it was in front of a bunch of bankers. So it was more contextualizing decentralized finance for banks. And I'm guessing that you guys are much more DeFi native, so I'll skip over a lot of the simple contextualization and more be, giving you, insights into how traditional credit markets work. Another thing, this was done in March, so, we have an ode to a higher TVL. But the point of this slide is, if we look at the construction of DeFi markets, almost everything is locked into these very short-term money markets, right? So, if you go on a flash loan, you obviously have this credit instrument that lasts 1 Ethereum block or about 13 seconds, right? So this is really nice, it's useful, it's really cool, but it's really useless, if we want to get to this point where we can actually take a 30-year mortgage to buy a house, from a decentralized bank. So the question is, how do we get from point A to point B? So if we look at the traditional financial markets, actually these very short-term instruments are a tiny portion of the credit markets. Actually, you have most things that are locked up. You have this term structure. You have these instruments that you have to keep in for a certain amount of time. These are the fixed income markets. These are the bond markets. And what's underpinning these markets is actually this monster market, which is the interest rate derivatives, which is about $450 trillion notional volume. So I don't have to go over the overcollateralization with you guys, but one of the interesting things is that overcollateralization, we know that it's a technical issue. You have the infinite rehypothecation of assets risk. But we actually do have a good, proxy to this model, which is securities lending in traditional markets. So in traditional markets, you can lend out a security, you can borrow against it, and not effectuate capital gains, for example. This is obviously not a comprehensive list, but you have the over-collateralized markets, you have Aave, you have Compound, or let's say Trader Joe and Binky on Avalanche. But you also have these different, models coming out like Goldfinch, which is essentially issuing an NFT. It's following a traditional, more securitization process. It's assessing the risk of the counterparty. Or you have something like Centrifuge, which is tokenizing, let's say, the physical world assets and being able to issue them on chain. Or you have something like structured products like, for example, Fortunify, which is up and coming, and it's looking to actually create a basket of assets and issue a stablecoin against that, which has a diversified yield. And maybe this is something that's very interesting in this market, where you have actually the stablecoin yields which are dropping to the floor, but you have these, these central bank rates which are, earning a lot more than DeFi yield right now. So what we need to go from is these very liquid, very short-term markets to much more longer-term structures, much more stable structures. Because for example, institutional finance requires some level of predictability, some level of risk management, and risk management, in this current market climate is something that a lot of people are talking about, but we don't see a lot. For example, we see Celsius paying down their debts on Aave, on Compound, but we also understand that they have full rate exposure. So if we add these kind of market stabilizing instruments, then we can have a much more secure market structure. If you're familiar with how the calculation for the interest rates is done on Aave and Compound, and actually many money markets across other chains, it's a simple utilization curve. So cash borrowers over cash available. And so what happens is actually you kind of get this hockey stick movement when you reach over a certain level of utilization, then you get these massive volatility spikes in the interest rate behavior, which also creates, let's say, a very unstable market dynamics, where you can have, where you take a rate, you take a loan at 3%, and 24 hours later it's sitting at 30%, you know. So this is obviously something, again, from institutional standpoint, that's unacceptable. Okay, but if we look at this leak out from the TVL side, what do we see? So we actually have this collapsing of the asset value, but we had a huge growth in stablecoin issuance, and actually not a lot of the stablecoins have left the system. So we actually have this huge oversupply or the surplus of stablecoins in the market. And I mean, actually, what's happened is it's not that people are probably borrowing less. It's not that a lot of assets have actually gone out of these DeFi lending protocols. It's that you're essentially, your credit capacity is capped, right? So all of a sudden we have this huge excess liquidity in the market in terms of stablecoin. You have fewer people borrowing. You also have a lessened ability to borrow. And so that has really driven the interest rates down over time. So, you know, if you talked about, you know, DeFi summer, or maybe shortly thereafter, you could guarantee maybe about 10% per annum lending stables. Well, the USDC rate right now is hovering just about around 1%. And you had this behavior, all the stablecoin markets were pretty closely tracking each other, but we had this, this Tether redemption. I think around 16% of Tether were redeemed in the past few months, and so that's created this kind of divergent rate behavior between USDT and USDC. Okay, so who here knows what the LIBOR is, or the LIBOR was? Okay, so we got a few hands, so I guess I'll give some really quick context. So the LIBOR was the London Interbank Offered Rate. So the London Interbank Offered Rate, it was actually discontinued at the end of last year, and I'll tell you why a bit later. But it's this survey-based rate, which is meant to be a free market alternative to central bank rates. So 16 London banks got together and they asked each other, okay, what's the cost of borrowing today, you know, across different currencies and across different maturities? Today, 1 month, 3 months, 6 months, 1 year, for example. And this was called the most important number in the world, right? So if you take a home loan, your bank might quote you LIBOR plus 50 basis points or LIBOR plus 0.5%. So this rate was used to structure hundreds of trillions of dollars in derivatives, deals, credit products. But there was a problem. So what was the issue? So the LIBOR is also known as the biggest rate fixing scandal in history. So this came out in the early 2010s, but it had actually been going on since the late 90s, which was inside the banks, the traders themselves were underreporting or overreporting the LIBOR by basis points. And they were taking the opposite side of this trade and pocketing the money. So the people inside the banks that were trying to create this free market rate were manipulating the rate for their own personal gain. So we have this function of a benchmark rate that is extremely powerful in traditional finance. Actually, the LIBOR's discontinuation caused a couple of different systemic risks, which is essentially you had a couple benchmark rates that were vying to take over from the LIBOR. But what that creates is, it creates a fragmentation of liquidity risks, discontinuation of different contracts. But what we get from that is actually this benchmark rate is something that is required by the market. It's required to understand, how the market works. This transparent rate on which we can base other behavior. What we reject in the DeFi world is obviously the manipulation point. And what we can get in decentralized finance is we don't have to ask banks, we can just ask the smart contracts. So this is the IPOR, the interprotocol offered rate, or we can call it the interprotocol overblock rate, which is sourced block over block. So the LIBOR was, it was published, I think, 11 a.m. BST, Monday to Friday, and not counting holidays, because, bankers need their holidays. Well, we can have this transparent overblock or as close to real-time rate as possible in decentralized finance, and this is really something amazing. So we embrace at the IPOR this idea of a benchmark rate. We reject the idea of manipulation, and we can get this proxy to as close to real time as possible. And so this is something really interesting. So another thing, there's a couple of different rates. So if we talk about the LIBOR was financial institution based, right? You have a subset of banks that are reporting to the LIBOR. So we can also copy that inside of the interprotocol offered rate, where essentially these credit market protocols are proxies to financial institutions. So we have this construction of understanding what protocols or what proxies to financial institutions should be included in this IPOR rate. And this is something that I shouldn't be in charge of. This is something that is a very good case for community governance. So, for example, right now the IPOR rate it's a summary of AVE and compound. Why? It's simply a volume weighting. The other markets, in terms of magnitude, they just wouldn't move the rate enough at this time, right? And there's also technical limitations that it just makes it more complex and really no reason. But let's imagine that there's protocol X. Protocol X comes up, and it really has a better interest rate model. It has something changed from this simple bonding curve, this utilization curve, and they're really killing it with this with their new credit protocol, right? So what happens? How does this protocol X actually get included into the IPOR? Well, we think this is a great case for decentralized governance. And the IPOR, as it's a volume weighted, as liquidity flows into that credit protocol, the IPOR rate would actually, the IPOR rate would show, essentially reflect the behavior of what's happening in the market. So the IPOR isn't setting the rate. It's not setting the market. It's more like a barometer. It's a thermometer. It's reading the temperature in the room. And so this is something that's very interesting on the decentralized governance side. And the other thing is, let's say, how does another stablecoin, spin up a new IPOR rate? And this is other things that are going to decentralized governance. And also, how does the IPOR go cross-chain? So, for example, the IPOR is launching on Ethereum layer 1. Why? Because that's where the most liquid credit markets are. But IPOR is essentially long decentralized credit markets. It's not pegged to Ethereum. It's long DeFi credit. So how does this rate go cross-chain? And I'll speak a little bit about the infrastructure, the technical infrastructure later. Sorry, well, one last point about this. You have this proxy to financial institutions through the protocols, but you have something like the BSBY, which is the Bloomberg short-term bank rate. And this is market-driven, right? So what we get from the smart contracts is actually all of the activity that happens, across that smart contract is included into the rate. So you have this transparent, also transaction-driven and market-driven approach. So the IPOR is, let's say, maybe the best of both worlds, where we have this proxy to the actual market activity and the market transactions, as well as the proxy to financial institutions. Okay, so this is the interprotocol offered rate, or the IPOR rates, right? So we can see here, actually, in March, we had this kind of divergent behavior. We had a little higher yield, across all markets. And, again, because of this dynamic of the collapsing price and the surplus of stablecoins, we have this rate dynamic. But this is essentially how the IPOR looks. And we can consider it a spot rate right now. Why? Because we have no semblance of really a term structure in decentralized finance right now. So think of it as an IPOR USDC spot index, IPOR USDT spot index, IPOR DAI. But in the future, you could see different stablecoins here. And some interesting other things, are both Tether and Circle are issuing euros, which, given to the exchange rate, is not so different from the dollar at this point. But there's different kinds of trading opportunities, different basis trades, different cross-currency swaps that are potentially possible in decentralized finance, and these are huge markets in traditional finance. Okay, so again, some advantages that we talked about this already a bit, but it's sourced directly on chain. It's a volume-weighted average, and we reject the manipulation. So maybe I'll use this time to talk a little bit about the construction, right? So we could really calculate the IPOR on-chain block over block, but that would just be a great subsidy for Ethereum miners. So if you guys are Ethereum miners, sorry, we're not subsidizing every block because it would be a ridiculous waste. But we have this kind of off-chain, on-chain construction simply because of gas fees. So how the IPOR oracle is structured, and it's a bespoke oracle, is essentially listening to full nodes, indexing this behavior block over block, and that's published every so often. So it's published via a function called heartbeat, which is a time and volatility function. So a short time requires high volatility to be republished. Over a long time, the volatility lessens, right? And so this is just a way to have this nice dynamic of market behavior, not subsidizing the publication online. And so you'll actually have like two different IPORs. One is kind of the off-chain IPOR, which is being sourced block over block, which also can be verified. The formula is open source. And then you have the on-chain publication. So this on-chain oracle publication, you can have also these entire new models around this. So in the long term, there could be multiple validators, multiple essentially IPOR calculators that are vying to publish this through, through the oracle. So you have something like a chain link style economy around the publication and the sanctity of the IPOR rate itself. Okay, so the IPOR, as an oracle construct, it exists as a public good. We have the modularity and adaptability and the composability, so what do you do with this public good? And so this is a big question that, we're actually leaving to the builders, and this is one of the things that we want to talk about here, especially at ETHCC. So if you have this rate that lives transparently, it's on-chain, it's immutable, and, it's essentially sitting there for anyone to use. Can we reconstruct this value, for example, of the LIBOR? Can we use this as the base of the different credit markets? So what are some things that you can do with this on-chain good? So we'll get to some ideas later on about more complex structures. But for example, let's say if you want to fork Aave or you want to fork Compound and you want to come up with a new rate structure, well, you could just quote essentially the IPOR Index and add some spread between the borrow and asked. Right, so you have these new kinds of possibilities that are possible because of this construction. Okay, so the first instrument that IPOR Labs has built to essentially leverage the IPOR is an interest rate swap. So interest rate swap, it's one of the deepest markets, in OTC derivatives. And it essentially hedges rate exposure. And so this is something, for example, if you're taking a home loan and they ask you if you want a variable rate or a fixed rate, a lot of people take fixed. So what's happening is this rate exposure is being hedged, likely from an interest rate swap. So what do we do in IPOR interest rate swap? It's a peer-to-pool model. So peer-to-pool, so if, for example, if you want to go long or short versus the IPOR USDC, USDT, or DAI rate, on one side you have a depositor in one of those stablecoins. On the other side, you're taking an instrument, so you're taking either essentially a long or short, a pay fixed or a receive fixed position, and you're betting against the pool. You have the AMM, which is essentially pricing risk in terms of volatility and volume, so it's essentially fixing that risk into a spread. So you'll get quoted, once you open your contract, you'll get quoted a fixed rate, and that fixed rate will be determined by the AMM, and then the payoff between these two contracts will be determined by the IPOR over time, which would be the floating rate. So we have several quants working on the IPOR Index. We have a team of 3 quants. Our chief scientist, he set up a trading desk at one of the large crypto houses in Japan, and actually we have 2 quants that have over 20 years in fixed income. So one thing that we looked at is actually the extremely volatile rate behavior in DeFi. It resembles something like an emerging market, bond market, rate market. So we're actually looking in, so our chief quant is actually Brazilian living in Tokyo. And actually the Brazilian rate structure, it very closely resembles the volatility that we find in decentralized finance. So we took this model, for example, called Jump Diffusion, and essentially taking this entire quant toolkit and putting it into an on-chain constant function market maker. And so this is really, let's say, the magic behind the interest rate swap profile. We'll be launching, let's say, I think 4 white papers in the next month if you want to read more about that. So you can follow IPOR on any of our, any of the social accounts. And we have a couple other things, but you can imagine that it's some kind of this manifold between volatility and volume. So instead of, let's say, kind of a 2-dimensional approach as in Uniswap, we're thinking about 3 dimensions when talking about interest rates. Okay, so here's a stat from the interface. So for example, what do you use IPOR interest rate derivatives for? Well, you can hedge essentially your borrowing or lending, right? So typically if you're a lender, you're going to take receive fixed because you don't want your yields to go down. On the other side, if you're a net borrower, you're going to pay fixed. So there's a very interesting dynamic, a very interesting yield inversion that has happened right now. So for example, if you want to take an arbitrage or a carry trade right now, there's a possibility to borrow USDC, take a pay fixed contract, and lend it out in short-term US Treasury bonds. So I never thought that we would see kind of this carry trade, but it's possible right now. And so this is one of the potential uses. But again, in this time where we're talking about risk management, and we're seeing that essentially risk management on the credit side is really lacking, then this is why IPOR actually becomes a very important part of the market. It becomes a stabilizing layer under the DeFi credit markets. So, again, we have this, if we're looking at how the IPOR looks in a traditional kind of business model, if you're thinking about the decentralized governance side, you have this, let's say this kind of transparent data layer. So you have the spot indexes, but you have different fixed income protocols. And we'll be also, the next product or protocol that we'll be looking at is interest rate futures market. And the interest rate futures market is a good way to kind of bootstrap this yield curve in DeFi. And so the reason we're starting with a spot rate and essentially extending it, you'll say 1 month at a time, is because we don't have this semblance of a yield curve. We don't have this, let's say, term structure in decentralized finance, but this is something that we're bootstrapping now and into the future. So we'll start to see this development of the IPOR 1 month, 3 month rate, 6 month rate. On the other side, you get kind of this, let's say, this credit market stack, right? So you can have a module that really calls to these rates to structure a credit product, right? You can have you can do a multi-contract call to, let's say, take a debt position on different money markets and have an instant hedge, right? And so these are some things, this kind of base layers that can be built into the interfaces, Zappers, Zerion, DBank, a one-click hedge, but you can also create larger structured products. And so this is kind of the base. These are the base instruments that we're creating to create this, let's say the base of the DeFi credit markets, but also these building blocks for structured credit products. And so this is one of the things that we're really kind of excited about at IPOR. And then finally, the IPOR Labs team. So actually, Mario is right here in the front. He is let's say the man on all the smart contract side. So if you want to understand the construction of the IPOR, the protocol, be sure to grab him and talk to him afterwards. But again, we have guys coming from, we're about 16 strong. Our developers come from enterprise software development, anywhere from 10, 15 years. Our quants, again, are coming from a deep background. And yeah, so that's a little bit about the IPOR protocol. If you want to learn more, you can go to IPOR.io, follow us on Twitter, IPOR_IO. My name is Darren Camas. You can find me on Twitter, Darren Camas. And if we have any questions, I don't know if we have time for questions. 5 minutes.
Hello, yes, thanks a lot. Very interesting presentation. What's the current business model or plan to monetize the IPOR rate?
Okay, so there will be an IPOR token, for example, right? So a couple of different things, right? So you have these instruments, right? The interest rate swap, for example. It's a derivatives DEX. Right, so this is something that's not public yet. It won't be public for a while. But if we go back to this, so my co-founder Dimitar, he's our CSO. He's the tokenomics gigabrain. So we've iterated something like the V-curve model, something like Badger DAO. So we have some kind of boost dynamic inside of the derivatives DEX. Some kind of fair market, fair market dynamic where there's no locking up. So you'll have to stay tuned for that. So that's one. But the other side is really, the decentralized governance around the rate. So it's maybe harder to conceptualize or from a fundamental perspective. But imagine if there were decentralized governance around the LIBOR itself, right? So it's essentially this, an index it's not rocket science to create. The point of this on-chain index is that it's this public good. One, it provides transparency around what's happening in the credit markets. Two, you can build on it. So, you might have these decentralized banks that are offering a 30-year mortgage that are quoting the IPOR, some spread, and they're taking different derivatives on the backside to essentially hedge risk, right? And so, in the way that the LIBOR, had hundreds of trillions in deals essentially tied to it, the value of the IPOR index will be essentially how many external contracts are referencing the IPOR rate to structure their own deals. And, if the IPOR takes this kind of LIBOR-like importance inside this ecosystem, then there's going to be a huge amount of value around the construction of the IPOR index. Which protocols are included? What's the governance process if a protocol is excluded from the rate? Let's say in the case of like Cream, which had multiple hacks. Let's say if Cream was a part of the IPOR index, how does this get excluded from the rate? How does the index go cross-chain? And then on the Oracle side, there can be this entire monetization by the different index calculators. So kind of this sanctity of the IPOR and the importance of it living on chain, there can be an entire token model around the publication of the IPOR, as long as there's, it's essentially the volume that's pegged to this on-chain public good. Yes. Are we finished? Okay. All right, thank you guys.